Nike Inc. ticker symbol NKE is currently trading at $71 a share. Year to date, this stock is down almost 6.5%, and on the last year, it is down about 30%. This is the lowest it's been if we go on the 5-year chart since the pandemic year of 2020, where it hit lows of around about $67. So since that time, in those 5 years, it is up almost 5%, but it is down from its highs. Can it get back to those values? That is the question we're going to be looking at today. What we're going to be doing is looking at my automated stock valuation spreadsheet, seeing if Nike is a buy using the discounted free cash flow model, comparable company model, dividend discount model, and the Ben Graham formula for intrinsic value. So, as I said, we will look at my sheet here and we will type in the ticker NKE, and this will load all the latest company financial data so we can have a deeper look. If you're interested, check my Patreon. We'll talk about that more later. So Nike Inc. currently at about $70 a share, $70.84, $106 billion market cap, PE ratio of 21.88, which is much lower than the market average, which is 30.6. So a good start, potentially undervalued. Earnings per share, $3.24, a beta of 1.02, meaning it is just about as volatile as the market. And analysts have a target price of $86.78, which meaning it is a buy. Dividend, this is a popular dividend stock, 2.08% yield, which means you'll get paid $1.47 per share. If you want to get paid the dividend by before the 2nd of March, that's the ex-dividend date, and you'll get paid your quarterly dividend. It is safe. You can see here they pay around $1.7 billion, 35 and 31% on the net income and free cash flow payout ratios. So looking okay for a dividend. So let's have a look at the numbers here. Revenue, it is down. Trailing 12 months, $49.04 billion. It is down from its all-time highs, which was the prior year before, which was 51.5. Nike has had pretty consistent revenue growth. This is going back to 2010. But you can see here they dropped down the pandemic year and have dropped down here. So if we look at the financials here, we can see why. We have the 3 months ended and the 6 months ended here. 6 months ended from the prior year, 26.3 to 23.9, apologies. So that is a 9% decrease. And if we look at the 3 months ended on the revenue, 13.3 or 13.4 from the prior year down to 12.3. We scroll down a bit here, we can see how this is broken down. This is the revenues by division. We'll just look at the 3 months ended for now, but the largest segment here is the, well, North America obviously, but then specifically the footwear. Footwear is down about 14% from 3.7 to 3.2. Overall, that means that the total is down from 5.6 to 5.2. Yes, apparel is up and equipment is up, but these are much smaller than the North America footwear. We look at Europe footwear as well. That is down 2.1 to just shy of 2. In fact, down across the board, apart from equipment, apparel is down as well. Footwear, China, it's down. And also everywhere. So the largest part of Nike, which is their footwear, is consistently down. The total Nike brand being down about 7% in that prior year. And here, oh, they do the maths for me. Footwear, which is the largest section of their business, 8.3 down to 7.5. Apparel is relatively flat, and everything else is up ever so slightly. But the biggest chunk is their footwear, which is obviously why that if we go back to here, we can see the revenues are down. So not looking too good there. Net income. Are they more profitable? Not really. 4.89 billion, pretty much up on the all-time highs, but you can see it has been decreasing steadily over the last few years. Free cash flow, a similar story again, 5.25 billion. And if we look at operating cash flow here versus capex, you can see operating cash flow is down, which is why the free cash flow is down. Capex has actually decreased over the last few years, but operating cash flow is down. Shares outstanding, what are they doing? Well, they're rewarding shareholders through buybacks. We'll ignore the splits back here, but they've had a pretty consistent buyback program. So let's have a look at the discounted free cash flow model. This way of valuing companies, looking at their future free cash flows and discounting them to today's value. Let me just see if we have all the numbers here. Yes. So currently it's actually giving us at about $70 a share, so trading at a slight discount. So let's see if we agree with these numbers. Firstly, we'll look at the net income, the revenue. We're expecting increasing growth over the next few years, but we have seen that Nike is on the down. Let's see what analysts are saying. Current year, see, on the sort of bearish estimates, they are expecting negative growth. If we look at the quite high in the growth estimates for next year, quite interesting. But we can see here that next year is down, and then 2026 they're expecting to go up. So we'll go on the more bearish case here. We'll go say their revenue decreases at that 5%, puts it at $53 a share. Net incomes, I'll keep them about the same, although the margins are declining ever so slightly. We'll do that at about 10%. $47 a share. And then we'll take an average of these years here. We'll ignore 2022. So that puts us about 97%. So if their revenue continues to decline, $55 a share is more fair. Although if they were able to take an average of the last 5 years, which was sort of increasing revenue, it would be about fairly valued. So not really liked on the discounted free cash flow model. We'll quickly look at the dividend discount model. Intrinsic were very low, so we'll increase this quite a bit to 7%, well, 6%. Yeah, so they need to have consistent dividend increases about 6% to be fairly valued. I don't really like this model for some companies here. It doesn't seem very useful, and Nike's one of the ones where it's not. Ben Graham formula for intrinsic value, I don't think it'll like this, although the analysts are expecting high growth, as we saw. They're expecting around about 20%, 19.5%. So interestingly buy, but about fairly valued again, $76 a share, Graham price, which is a margin of safety, about 57. So the discounted free cash flow model puts it at fairly valued, and that's kind of on the more bullish case. If the revenue continues to decline, then obviously not. Dividend discount model thinks it's about fairly valued. Ben Graham puts it about fairly valued. So finally, we'll look at the comparable company model. This is the way of valuing companies, looking at similar companies in similar industries, and then the metrics we're looking at are EV to revenue, EV to EBITDA, PE, forward PE, but then we're also looking at revenue, growth rates, EBITDA, net income, profit margins, price to sales, price to book, and PEG, which is Peter Lynch's price to earnings growth. So the companies I did compare to it last time was SKX, which is Skechers. We'll look at Crocs as well, which I believe is ticker symbol, nope, maybe just 1X. 1X would make more sense. Yep. And then UA, which is Under Armour. So what they'll do is this will load all the latest company financial data for these companies, and we can have a compare. If you're interested in this, please check out my Patreon, links are in the description, but this is the $4 tier. $4 a month gives you access to the sheet and all the data. If you want to just help me out, $1.50, or if you want the higher tier, that's $7. But the community is growing here, and got some happy customers, so hopefully I can keep on providing this service. So unfortunately, Under Armour does not have a PE, so it's not going to like that. But Nike is the biggest, almost 10 times or more than 10 times larger than all of these. Revenue, highest revenue, 50 billion, so blowing them out of the water here. Revenue growth rate over the last 5 years is slower. I might add a more recent one in here to kind of see what it's doing, because obviously Nike's turnaround has decreased, or revenue has decreased recently. Net income, highest. Profit margins, second highest. Price to sales, market average is around about 3, so they're all lower than that, but Nike is highest with 2.1. Price to book, market average is 5, it is the highest. PEG, highest as well. EV to revenue, higher. EV to EBITDA on the middle of the pack. PE, higher. So it doesn't look fairly valued. Unfortunately, Under Armour is here, so let me see if I put the sheet here and we can remove it. If we compare it to Skechers and Crocs, overvalued, $50. So currently, looking at all of the models, dividend discount model, about fairly valued. Ben Graham formula, about fairly valued. Comparable company model, overvalued. And discounted free cash flow model has it on sort of a bullish case to be about fairly valued. But if the revenues are still declining, say minus 3%, oops, we'll just do equals that, minus 5, $50 a share. So not looking too good for Nike. Right guys, thanks for watching. Please give a like on the video if you enjoyed, subscribe if you're not already, and I'll catch you guys next time.